Today, we're going to be diving into a topic on everybody's mind as we head into election season. How would this presidential election impact the stock market? Hey guys, welcome back to our Flex Free Game YouTube channel. Today, we're going to be diving into a topic on everybody's mind as we head into election season. How would this presidential election impact the stock market? So if you've been trading and investing in the stock market for a while now, you know that politics can influence the stock market movements. And of course, if you have a good understanding on the relationship between politics and how it can impact the market, that all can help you make informed decisions. And that's what we want to help you do today in this video. So first, let's take a quick look on how the stock market has performed historically during and after presidential elections. Historically, the market tends to be volatile in the months leading up to the election. But once we actually get the results and everything is clear, then we usually see some stability come back into the market. For example, since 1928, the S&P 500 has averaged about 6.5% gain in a presidential election year. And in the years where the current president is actually re-elected, the S&P 500 sees an average gain of about 13.4%, while gains of just 5.4% in the years where the current president loses and a new president takes over. So the market tends to like when a current president is actually reelected. But we won't get that in this current election cycle here. So however, the market performance doesn't always depend on who wins, but rather on the clarity of the results and whether the election causes significant uncertainty or not. So that's really why the market has volatility. So as traders, we don't necessarily care about who wins the actual election, but how the market's going to react to it and react to the outcome and how we're going to react to the market's reaction, right? That's what we care about. So now let's take a dive into party-specific trends. Generally, markets have shown strongest performance under both parties, whether Republican or Democrat, but there are some key differences to be aware of. Under a Democratic president, the S&P 500 has returned about an average of about 10.2% annually since 1945, while under Republican presidents, it's averaged around 6.9%. So it looks like Democratic presidents have generally been better for the stock market. However, Republican presidents are often perceived as more market-friendly due to their stance on corporate taxes and also their stance on deregulation, while Democratic presidents might focus more on broader social spending and also higher corporate taxes, which corporations don't like. The bottom line is, while the media likes to focus on who's better for the overall stock market, historically, both parties have really delivered pretty positive returns when it comes to the market. What really matters is the economic cycle. Once we actually get the president, what's going to happen, what their economic policies are going to be, and that's what's going to impact the stock market. So now let's talk about some key factors that really drive the market reaction to a presidential election. Presidential policies can have a real impact on certain sectors within the market, and traders need to keep an eye on a few different key factors, right? Number one, you really need to keep an eye and pay attention to taxes. Tax policy is huge. For example, Trump's 2017 corporate tax cut was a major catalyst for a stock market rally back in 2017. And if a new president proposes raising corporate taxes, we could see that impact the market. We could see some pressure come into stocks, especially on sectors like technology and sectors like healthcare. Also, we need to pay attention to, and a key factor is regulation. Deregulation typically boosts industries like oil and gas, whereas increased regulation may put some pressure on industries like financials. And again, big technology can be impacted as well. Lastly, the key factor we need to pay attention to is trade policy. Trade wars can be significant headwinds for the stock market, and a policy that really restricts international trading can hurt companies that have a global presence, whereas more of an open trade approach can be more beneficial to those companies that do business internationally. And then also Federal Reserve policy, though not controlled directly by the president, the Federal Reserve, the Fed's monetary policy can be a huge role and impact the stock market. Historically, Fed rate cuts or Fed rate hikes in response to elections or election outcomes or economic policies can create major market swings. As we all know by now, if you've been trading and investing in this market in 2024, that's a lot of what we're experiencing right now is the impact of the Federal Reserve rate hikes and now lowering interest rates on the market. So what should we expect in this current election cycle as traders and investors? As we get closer to election day, expect to see continued volatility in the market. In fact, a study by LPL Financial, market volatility tends to spike about 3 months prior to election day. And we've already seen signs of that happening now and all throughout 2024, really, right? Knowing that this is an election year. Since the beginning of this year, 2024, the VIX, often known as the Fear Index, has averaged around 20 to 22, which is higher than those post-pandemic levels in the post-pandemic average. So again, that uncertainty is affecting the market. And we all know that the stock market hates uncertainty. And the 2024 election is shaping up to be a very close race, again, causing that uncertainty in the market and bringing in that volatility. Whether it's economic policies, trade agreements, or tax plans, again, both parties have very different platforms, and traders need to stay sharp and understand how they're going to react and be able to navigate any potential swings that we see come up in this stock market. So how can you, as a trader, me as a trader, us as traders, make the most of this election season? So here's a few quick tips. Number one, you need to stay diversified. Don't put all your eggs in one basket. Spread out your investments across different sectors to hedge against any policy changes that we might see in this presidential election. Number two, you will need to look for opportunities within the volatility. In our program, we have a strategy called volatility trading. Volatility creates a lot of opportunities in the stock market. And also when it comes to options trading, strategies like covered calls and bear call spreads can help protect your portfolio and also help you generate income during those uncertain times. We actually just did a video. Check that training out on covered call writing. You can see that on our YouTube video list, and check that out if you want to know a guaranteed predictable income strategy in the market. That's a good training that you can check out. And then lastly, you need to focus on long-term trends. While the election can cause short-term swings, can cause volatility, the stock market tends to rise over time in the long run. That is historically proven. So stick to your long-term strategy and don't get too caught up in the daily noise, and you're going to be just fine. So that wraps up today's video. Thank you guys for hanging in there and watching. So remember, while we're in the election season, the elections can certainly shake up the markets. They're just one part of the bigger picture. If you found this video helpful, hit that like button, hit that subscribe button, comment below. Again, hit the subscribe button so you can stay in tune with us and get those tips on trading and navigating the market events. We'll see you guys next time. Stay safe out there. Happy trading.